Welcome back to Resonance Spotlight Strategy Notes with Vincent and Saâd. So today, we are looking at something that's been reshaping the whole quantitative finance landscape. And I say reshaping because unless you're really paying attention, you might miss how significant this actually is.
Yes, exactly. The Financial Times published a piece on this recently, prop shops versus pot shops. And it sounds like just another market story, but when you look at what's actually happening, what we're seeing is not just two types of firms competing. It's a real convergence. High frequency prop trading firms and large quant hedge funds, these used to be completely different animals in different ecosystems. Now they're competing head to head for the same alpha.
This is not happening because they want to do this. This is convergence through necessity. So let's break down why this is happening, what it means for the strategies that have been working for decades, and why allocators need to completely rethink how they look at these managers.
Okay, so let's start with the prop shops. For about 2 decades, these firms had this really elegant business model.
Speed compounds.
Exactly. If you can execute trades in microseconds instead of milliseconds, you can arbitrage tiny inefficiencies again and again and again. Market making, latency arbitrage, these strategies generated exceptional returns. And the nice thing was, you didn't need huge amounts of capital to do it.
But here's where it becomes interesting. These firms got really, really good at this. So good that they started accumulating serious capital. We are talking billions, sometimes tens of billions.
And that's,
Capacity trap.
yes, because ultra high frequency strategies cannot absorb that scale. You cannot just take a latency arbitrage strategy that works with 100 million and scale it into 10 billion. The mathematics don't work like that.
Actually, it's worse than that. The returns don't just fail to scale linearly, they collapse. Because every additional dollar you put in is chasing the same limited pool of mispricing. You're competing in a zero-sum game, and now you're competing against yourself.
So, I repeat. So, what do? You have billions in capital, your core HFT strategies cannot absorb it, and you cannot just give back the money.
You move up the frequency spectrum.
Exactly. Statistical arbitrage over seconds instead of microseconds. Momentum strategies that play out over hours. Cross-asset macro signals that develop over days. And this is really important to understand. This is not like they're trying something on the side. This is existential. This is survival.
Here's the important point. Those medium frequency strategies, that's exactly where quantitative hedge funds build their entire business.
Right. So now, I repeat. Right. So Hudson River Trading, Jump Trading, Jane Street, they're not just competing with each other in the HFT space anymore. They're entering the arena with Millennium's pods, with Two Sigma, with all the traditional quant players.
Some of them are going even further. They're hiring discretionary portfolio managers, building pod-like structures. And if you show these organizational charts to the founders from 15 years ago, they will not recognize their own firm.
Okay, but there's another layer to this story that's quite ironic.
Passive investing.
Yes, because both of these groups, the HFT firms and the quant hedge funds, they both owe their growth to the same thing, the rise of passive investing. But they benefited from opposite sides of it.
Tell me more about that.
So for HFT firms, passive flows created structural opportunities. Every time there is an ETF creation or redemption, every index rebalance, every $1 billion flowing into the S&P 500 trackers, all of that creates predictable, exploitable order flow.
They became the infrastructure.
Exactly. They're the pipes. The market making business became incredibly valuable because passive investing needed someone to facilitate all those trades. They collected rents on the automation of asset management itself.
And on the other side, Traditional active managers are losing assets to Vanguard and BlackRock. So institutional allocators have this problem. Passive gives them better, but who is delivering alpha?
Enter the quant hedge funds. They position themselves as the rigorous, data driven alternative to stock picking. Factor investing, momentum harvesting, machine learning models. They offered something discretionary managers could not guarantee anymore: consistency.
So passive investing helped both groups, but in completely different ways.
Right. But now, both groups are facing the downside of their own success.
The inefficiencies they were exploiting have been arbitraged away. Spreads are compressed, correlations are higher, the alpha pool is getting smaller.
And everyone's fishing in the same water now.
So let's talk about what this actually means for people allocating capital. Because this is not just an interesting market story, this has real implications.
First, there's what I call the alpha compression cycle. When Jane Street is putting capital in the same statistical arbitrage strategies as Millennium pods, they're not expanding the opportunity set, they're dividing it.
And it creates this feedback loop. Returns compress as competition gets more intense, so firms add more capital and more sophistication to maintain absolute profits, which compresses returns further, which means they need even more capital and sophistication.
And the end point is quite clear. Only the most efficient operators survive. If you have a bloated cost structure, expensive talent compensation, and an inflexible capital model, your return on equity is going to disappear faster than you can adapt.
So, what are the winners in this new world?
I think we're going to see 3 tiers. Tier 1 is the integrated platforms, firms that successfully combine HFT infrastructure with hedge fund sophistication. Think Two Sigma, Citadel. These are firms that can operate across the entire frequency spectrum and move capital dynamically wherever opportunities exist.
And tier 2 will be the specialized survivors, boutique firms with real, defensible edges in narrow niches. Maybe they have proprietary datasets, or maybe they have execution technology that nobody else has. They survive through excellence, not scale.
And there's tier 3, the squeezed middle. Pot shops without differentiated talent, or mid-tier prop firms that don't have the capital to compete at longer time frames. These firms are facing declining margins with very limited options.
That's quite brutal.
It is. But the other implication here is for due diligence. The old categories don't work anymore.
Right. Because when a prop trading firm launches a multi-strategy fund, or when a quantitative hedge fund starts making market, how do you even classify it?
You simply cannot. You have to ask completely different questions now. Where is the sustainable edge? Is it infrastructure, data, people, or just leverage and scale? How does the risk management work across all different time? I repeat, because a firm that's brilliant at millisecond risk control might really struggle with overnight exposure.
What's the true capacity? Because firms are increasingly hiding this by blending strategies with very different capacity
And
constraints.
maybe the most important question: who are you really competing against? If your quant manager is now facing Jane Street and Saâd, has the risk return profile changed fundamentally? Because it probably has.
So what does the future look like here? Because it seems like we are moving towards something quite different from what quantitative finance has been.
I think the barriers that separated market making from alpha generation or execution from portfolio construction, those are disappearing. What we're moving towards is a world where capital allocation platforms compete across all time frames at the same time. And the firms that are going to dominate are not necessarily the fastest or the biggest. They're the most architecturally complete. They have execution infrastructure that can trade at any speed, in any market, and at any scale. They have portfolio science that goes from tick by tick market making to multi-day macro positioning.
Capital efficiency that lets them move resources dynamically without organizational
And
friction.
the talent density that attracts the best people regardless of whether they think in nanoseconds or months.
That's not high frequency trading. That's not traditional quant.
It's full spectrum quant capital management. It's something new.
All right. So, if there's one thing to take away from this, it's that the convergence of prop shops and pod shops is not some strange quirk of market evolution. It's what happens when efficiency gains meet capacity constraints, when technology makes speed available to everyone, and when data becomes ubiquitous. And for allocators, the lesson is quite clear. Alpha doesn't live in a single time frame or strategy anymore. It lives in the ability to move between them, to redeploy capital as opportunities shift, to stay disciplined when others are taking too much risk, and to take a risk when others pull back. That's a good place to end. Thanks for listening. If you found this useful, share it with someone who's thinking about this question. We'll be back next time with another deep dive into the forces shaping investment strategies.
See you then.